All right, so I think we're here live, and I'm not seeing it populate on my screen yet, but I'm pretty sure we are live. So, Richard, welcome to our channel on the Investors Podcast.
It's
It
great
is
to be here, man. I'm excited.
it's such an honor to have you. I'm
Thank
such a
you.
big fan of what you do. So, for the audience that if you don't know, Dr. Richard Smith, he's the founder of a company called Trade Stops, and he's an expert in momentum investing. He's an expert in statistics, and we've had. I distinctly remember our lunch in Baltimore,
Yes.
and I really, really enjoyed that conversation. And so I was excited to try to replicate that through a live stream on our YouTube channel. So I just want to talk to you tonight, Richard, about how I'm seeing the market. I'm curious how you're seeing the market, and
Okay.
let's just talk about some different things. So, um, I want to start off by talking about a headline I read in the Wall Street Journal today, which was we are seeing the longest bull market in American history as of today, right?
Yep. Yeah,
I mean,
it's incredible.
it's totally insane.
And what it makes me think of is the biggest change in my own investing came when I stopped selling my winners, right? And I stopped questioning, like I stopped trying to anticipate when the bull market was going to end.
Yeah.
And
Well,
I'm always reminded of the Jesse Livermore, uh, quotes from Reminiscences of a Stock Operator. Of hey, it's a bull market.
yeah, and no, you're right. And when we talked,
You just can't get in the way of that. You can't stand in the way of that. And I remember in my early days, oh, it's gone up so much. It's time to get out, or worse, it's time to go short. Yeah,
yeah.
and it just
Well, we were talking with Bill Miller. For people that don't know who Bill Miller is, former CIO at Legg Mason.
yeah,
And at the end of the first time we interviewed Bill Miller, I asked him, I said, Bill, what's book do you recommend that I read? And kind of like, what's the main reason why you recommend that? And he said the Reminiscence of a Stock Operator. And he said the reason why, just for people, for some context, Bill was managing like 60, $70 billion in his prime.
yes,
He goes, the reason why is because of understanding the momentum of a long-term trend.
yeah,
And just to kind of even further that, I remember we were talking with Wes Gray, and Wes Gray is brilliant.
amazing
I don't
guy.
know how much you know about
Yeah,
Wes,
not
but
enough. I know
but
of him. I know Meb Faber, and he's told me about Wes Gray.
yeah,
Um, I'd like to meet him sometime.
but this was Wes's thing. We were 2-3 years ago. We were like, Wes, how much more can this thing go?
Yeah,
And like this, there's no way this thing's going higher. And he was just like, you know what, Preston, from a value standpoint, which I'm a hardcore value investor, there is no reason this should go higher. This is out of control. He says, but as a momentum investor, he said, I haven't sold anything yet.
yeah, absolutely.
And it's there's a lot to be said for that, because I'll tell you what, there's a lot of people that have been out of the market for the last 2 or 3 years, and man, this thing just keeps trucking along. And that's not me saying that it's going to keep going at this point, but all momentum indicators are, well, I want to take that back. I think there's some momentum indicators that are starting to say things are starting to get a little wobbly,
Yep.
but and you can talk that a lot more, and we can pull up some stuff from your platform and show people,
Sure.
um but it's still kind of in the green for some things. So uh, I
I
don't know. I want to hear your thoughts on some of those ideas.
Yeah, there's definitely still a lot of momentum in this market. I think sentiment is also not at extremes, and so I'm not selling.
Yeah, yeah,
And
exactly.
I think that there are, I did see some things that I was really concerned about back in February. I talked about this a little bit on the podcast that we did recently, especially in large cap stocks. The Dow Jones Industrial and the S&P 500 is where I had the most concern about the markets, and I still have the most concern about the Dow. I think the S&P is starting to recover nicely, but where I really saw the strongest momentum in the markets, of course, was in technology stocks, but also in mid caps and small cap stocks. And small cap stocks had continued to have the strongest momentum of all. And I really love the small cap story. And I think small caps are a great opportunity for investors, if you can take the opportunity to dig into them a little bit.
So what I want to do, Richard, is I want to show the audience. Oops, getting a little bit of audio feedback there. What I wanted to do is show the audience some different charts that I'm looking at today, and these are some more macro themes of where I think we're at and how it might be analogous to other points in time. And where, I pay very close attention to what central bankers are doing, how they're raising rates, and how the markets are kind of responding to that. And so far, the Fed's been raising rates. We still see the market hanging on, making new highs. And but what I want to do is I want to bring up a chart here. So what I'm going to do is I'm going to share my screen. So bear with me as I get this all sorted out. And I should have my screen shared right now, and you guys can see the trade stops because we're going to go back to that here in a little bit. But what I want to do is I want to show this screen right here. And where I'm at in time is 2007. You can see down here at the bottom, and I can kind of scroll around. Let me see if I can make this a little bit bigger for people. So this is a chart of oil. And you can see how oil performed from 2007 into 2008, and then the summer of 2008, and you can see how much it went up. It was down at like $42, and this is an ETF. This is not the actual price per barrel, just so people understand that. But the price more than doubled, almost it tripled up to this is all reflected in the ETF. Now, what's interesting when I look at this chart, I think that this is my personal opinion, and we're going to show what you're projecting on trade stops right now with respect to oil as far as a momentum indicator. But I personally think that oil is maybe getting ready for a big run, and not just oil, but other commodities as well, like gold. Now, the reason why I'm saying that, I want to pull up another chart here. There's a lot going on here, but as you can see, this is looking at inflation. This is looking at the 10-year Treasury rate and the federal funds rate over since 1960. Okay, let me see if I can zoom in on this one as well. The one that I want people to pay attention to is the federal funds rate. That's this red line, and this is what the Fed is. This is what the U.S. Fed is adjusting when they say they're raising rates and when they're not raising rates. Okay, so you can see this big giant. This would be like the Ray Dalio long-term credit cycle that you can graphically see from all those decades. Okay. But the one that I'm focusing on, going back to that oil chart, is you can see here from about the middle of 2004, right where my little hand mouse cursor is. You can see how they started raising interest rates, and the rates were at about 1% in this 2004 timeframe, and they raised them clear up to about 5%. On the federal funds rate. This isn't the 10-year Treasury. This is the federal funds rate. And then you can see the 10-year Treasury there. This would be the inversion of the bond yield curve when you hear people say inversion of the bond yield curve. And so you saw it flatten out, and you saw that they didn't raise rates for about a year, right in this period of time. And then in about the fall of 2007, basically the Fed capitulated and they said, this is not good. And they started lowering rates. And then in 2008 is when we saw the big stock meltdown. But when you look at when the rates started going flat, when the Fed basically stopped raising the federal funds rate, we're looking at, let me make sure I got the right date here. This is about the beginning of 2006, maybe after the first quarter of 2006. So now when we go back to the oil chart, okay. And we look at where oil really started to bottom, okay, it's right at that transition point where the Fed had stopped raising rates, and then they actually started to loosen for an entire year before you saw the market really start to get nasty. And so I kind of feel, and I might be wrong, the Fed might have a lot more rate rises in the future. They might have a whole nother year or two of rate rises. I don't necessarily feel like that is the case. I think that maybe they have maybe another year at most before they might start getting to the point where they can't raise it much further, mostly because they'll start inverting the bond yield curve. But what I find interesting, and I just jumped over to your trade stops platform. What I find interesting with your momentum, and this is completely based on statistics, is look at how long you have been projecting on your platform that oil is red.
Yeah.
The whole, I mean, from 2014, 15, it started getting squirrely, and you had basically a green yellow because it was running flat. And then as soon as it dropped, you turned it red.
Yep.
These just so people know, these projections are, you have no idea what's going to happen in the future. You're basing this off of the statistics of the price action.
Right.
You missed this entire downturn, but here, right before the start of 2018, you went green again.
Yeah.
And it kind of fits to the narrative that I'm kind of doing more on a fundamental side by looking over at, not that you can really do fundamental analysis with commodities, but it's a little bit more of a fundamental approach opposed to just price action, where I'm thinking that you're going to see maybe something like that again that we saw back then, and you're going to start to see the inflation of commodities really take off. Let me just to finish this out before I throw it over to you, because I really want to hear your comments on all this.
Okay.
But I want to show people where we're at today with oil, and you can see how oil has bottomed out, and you're already starting to see the market anticipate the Fed kind of reaching the limits with how much further they can go with the federal funds rate. So whether that's true, whether that's not, I don't know. I know that the price of oil is kind of struggling to make new highs here for the last month, and we might be a little early on this call. I wouldn't be surprised if we were a little early on the price really kind of going crazy.
Yep.
But this is something that I'm really paying a lot of attention to, and I think that it's an interesting narrative. So I'm curious what you think there, Richard.
Yeah, well, oil is one of my favorite topics, in part because it used to just be my absolute nemesis whenever I would try to make money in the oil markets. I did some commodities trading back 15 years ago or so. And it really speaks to kind of one of the really important things about my work. The momentum is part of it, but it's also really an understanding of volatility. And I like to describe it as the noise in the markets and different commodities and different equities, et cetera. So what I really didn't understand was how volatile oil is. I have this metric that I call the VQ, or the volatility quotient. You can see it right there on USO at 27%, right?
Let me talk here real fast so I can pull up the screen, Richard, so people, if I'm not talking, they're not going to be able to see this. So for me to just pull the video feed, you guys can see what he's talking about here is this 27.16% VQ for that oil ETF. So
and it's also up there in that black box, kind of top left of the screen. Says the stock state indicator, the SSI, is in the green zone, and then the VQ is 27%. So that means that oil can thrash around, 27, 30%, and really not give you any new information. That's just the noise or the volatility that's in oil if you want to be invested in oil for at least 12 to 18 months. So knowing that number really helped me to understand that, I couldn't really trade in and out of oil on a short-term basis very effectively, because, I would not realize that it was that volatile. So, and it's the combination of that volatility with the momentum that has really become the heart of my trade stop service and of the way that I personally, manage my investments. And you can see that here in oil, where to basically turn green again, in my system, it had to rise more than 27%, about 30% off of its bottom. Okay, and then that dashed line in the chart, when we get back to your screen in a second, is my momentum indicator, my trend indicator, basically, and that had to turn up after it had risen more than its expected volatility. So when you get those two things combined, it turns green. I was actually bullish on oil about 6 months before it turned green. But in the trade stop system, it turned green back there. What is that? Is that I can't quite see the axis on the chart down there. Maybe you could scroll.
Right about at the new year, right in January of 18 is when it kind of kicked into gear.
Yes. So anyway, I don't want to get overly technical or detailed, but yes, I think oil has great momentum. I agree with you that we could see continued upside in oil. I think that there will be some consolidation, but it is solidly in the green zone, as we say in the trade stops world.
Something that I think's also interesting discussion with a lot of this stuff is for the inflation aspect. The longer that this trade war kind of happens with China and the U.S., I think that that's going to drive prices higher, or it's going to put more pressure on the Fed in their ability to continue to raise rates. So if let's just say that the trade war ended tomorrow, if the trade war ends tomorrow, I think the Fed has a lot more runway to keep raising rates. But if these tariffs start kicking into high gear and the price of everything starts going up, the Fed really kind of has their hands tied, because what's happening on the fiscal and monetary side are not really kind of jiving together. They're kind of opposing each other. And I think that that's going to be a really interesting dynamic. And I think that that's probably why I have the opinion why I don't know how many more interest rate rises the Fed has under their belt before things really start to get squirrely.
Yep.
Yeah, you agree there, Richard?
Yes, I agree. Absolutely. I think they're going to run up against some ceilings sooner than they expect.
Yeah. What's your thoughts on gold? Do you see that kind of in the same way that we're talking the oil piece?
Well, I wish I could say yes, but I have some concerns about gold right now. I think if you pull it up in trade stops, it recently turned red.
Yeah, it did.
And I was very disappointed by that.
You and me both, trust me.
I really wanted gold to have continued momentum. I think gold is struggling right now with the rise in the dollar, and I also wonder how much the Bitcoin story and the digital gold story is kind of cutting into gold's thesis right now.
Yeah, I think that I read somewhere, I forget who said this. I think it was Meister, who has a really strong presence in the crypto space, and I agree with him on this. I think that gold's got one more run, assuming that the whole crypto thing really does kind of replace the mechanism for gold being the global monetary baseline. If that is a true statement, he said, I think gold's got at least another run in it to perform that role, but who knows and we could go down the crypto path.
Yeah. So anyway, that gold turning red really hurt, but it's red, and so what that means in my system, it doesn't mean, all the time that you sell. What it means is that, the momentum, according to my indicators, is on the wane. And also that gold, it's not that volatile. It's a 10% VQ in my trade stop system. So that means that, gold over a 12 to 18 month period should be just fine, kind of moving up or down by 10%. But when it falls more than 10%, that's a warning sign. Something's going on. It's moved beyond outside of its normal noise range. And that's definitely what we've seen here, and we've seen downside follow through in gold since it did get stopped out, since it did turn red in my system a couple weeks ago.
Well, let's
not very encouraging.
Yeah, I know. It's going to be interesting to see how much longer the dollar strength can hold on. I don't know how many more months that has, but I think that again is tied to the Fed continuing to raise rates, and I think it's also heavily tied to all this trade war stuff. If you see that change, I think that you're going to see the way that the dollar's being bid also change. But we'll see.
I mean, I think the U.S. economy is doing very well, and I think the tax cuts and I think the deregulation that's taken place is really spurring the economy. And there's not a lot of options out there. And then you have Turkey and what's happening over there with emerging markets, which is causing a rush back into dollars. So I think that this economy has momentum. And yes, there are concerns. There's the trade wars threats, but there's serious momentum in the U.S. economy, which of course makes the U.S. dollar stronger around the world as well. So I'm not so sure that we'll see the dollar really give up a lot of its gains anytime soon.
Well, and I think the other thing that people got to think about too, Richard, is where else are you going to get yield if you're going on the fixed income zero risk side of the house trying to buy some type of federal bond? Where else are you going to go in the world for the yield that you're getting here in the U.S. at the risk that the world has seen over the past decades? So I think that that's also driving dollar strength as people are moving into U.S. debt because of the yield that they're receiving relative to Japan or relative to Europe.
Yeah.
So, yeah.
Absolutely.
Hey, let's I want to pull up a chart here, and this one I just showed you guys that one. Okay, here's one I want to look at. So here we have the global market is the way I view this, and you got all major exchanges since the year 2000, and you can really see the credit cycles in this chart. So the dark blue is the U.S. You can kind of see the growth since the 2009 bottom. And you can see India there in the dark brown at the top. You can see the Shanghai there in the light blue. And you can see how the whole global economy is really kind of moving as, as a whole here.
Great chart.
Yeah. When you go back to 2008, you can kind of see how the Chinese market peaked first.
Yeah.
You can see how, I mean, they all kind of peaked at a very similar time, but you saw how choppy all of them got there at the top. And we're starting to see maybe a little bit of that choppiness right here in 2018. And so what I wanted to do is I want to go to trade stops, and I want to show you the momentum indicators for some of these major economies through different ETFs. So what I'm going to do is pull up trade stops, and I'm going to pull up China first. And China is FXI is one of the ETFs that we're going to do, kind of see what the momentum indicator is here on trade stops. And I don't know what this is going to show us, so I'm kind of curious to see what this is showing us. So this one recently turned red on June 25th, so not too long ago. And
Trade stops has nailed China, I would say.
You guys nailed that one. Let's go ahead and
look at that from the run, from 13 all the way through 15, capturing a lot of gains, and then from 16 all the way through early 18 and stopping out or turning red. It's
you're all over it.
Great, man. Thanks for pulling that up.
Good play. Let me go ahead and pull up the U.S. market. Let's look at.
My one of my best friends and mentors in the markets is Dr. Steve Sugarud, and he's very bullish on China right now, and I think for very good reason. But one of my favorite sayings, Preston, is the markets can remain irrational longer than I can remain solvent. And so I'm very happy with trade stops kind of giving me the warning on China that the upside momentum isn't there yet.
Well, and this is the reason why I want to kind of show people, going back to this original chart that we started with, because you can see everything very holistically with this chart, and you can kind of see that some markets tend to turn a little bit sooner than others. And so if we're looking at those momentum indicators across the whole spectrum of the world and the global economy, my expectation, and this might be a false assumption, but my expectation is we're going to see a similar credit contracting event moving forward into the future. Now, the timing is obviously the hard part, But as if we would look at the global economy and start to see some of those same indicators that we saw back in 2007, 2008, maybe we can have a better understanding of what might happen this time around. So this is just my approach of kind of understanding where we're at in the credit cycle, and I just kind of go ETF by ETF that captures each one of these major market and major economies. And so like China's starting to turn red. That's not good, but it has turned down in the past and continued to go up. So it's not 100% that this thing's turning, but it's an indicator, and it's something that people can consider. So let's look at the US one on trade stops. So when we look at this indicator, and you can see how flippin' accurate Richard has been with trade stops for the last 10 years. You can see, let me just pull up all so people can kind of see his projections since 1994. It's pretty incredible. So he would have stopped you out right in this time frame in the 2000 bubble in when was this? January of 2008. You would have been stopped out for the S&P 500, which was 9 months before this disaster even took place.
Yeah.
And then here you gave a green light in August of 2009, and you were green through.
Which, by the way, the market was up 50%.
Yeah.
By the time that happened, which another thing, and it is, in my experience as an investor, one of the big changes was when I first got started, I would have seen the market up 50% and said, "Oh, I missed it, right? I can't get in now."
Yeah.
And it's just not the way it works. So,
well, let me
myself about that.
Let me show people what's
whipsawed a little bit, in 16 and even 18. But overall, it's been a great indicator on the S&P 500.
Well, so let's look at what's happened more recently,
Richard. 2018, when we saw that volatility and it corrected, I was very concerned. Another thing I look at, Preston, you can't really see it in trade stops, but I look at, like, within the S&P 500, how many of the individual component stocks are in the red. And there was, over 40% of the stocks in the S&P 500 were also in the red around that time. So there was some pretty serious kind of internal decay in the component stocks of the S&P 500. So it hasn't made new highs yet, since it made those highs back in early 2018, the S&P 500. But it definitely has not followed through on the downside, after it corrected back there in January, February, and the momentum has started to turn back up, right? And it turned green a couple weeks ago.
Well, to give you some props, which you obviously don't need, because looking at this stuff is pretty it speaks for itself. But back in 2015, when the market started turning there, my impression is when it came back up here and met its previous high, I didn't buy this for a second. I really didn't. I was like, there is no way this thing's going to make another run like it just had. And your system turned green, and I was not using it back then. At this point in time, I sure as heck wish I was. But when I went back and looked at that call, I was like, there's no way I would have believed that.
I had the same feeling, and that, to me, that's one of the most amazing things about investing is how wrong you can be, even when you have all the information, the emotions don't go away, man. I was reading a great book. It's called Culture Code, and he was talking about the guy who was the one of the leaders of SEAL Team 6. You know his name? This guy, I think his name is David.
I don't know the name in the book, but that's Dan Coyle's book, and I highly recommend that book. It is one of the best books I've ever read on culture.
One of the best books I've ever read, too. So this guy was, I think he became the leader of the SEAL Team 6 groups, not, and there's, I don't know, a couple hundred people that are part of a SEAL group. Anyway, he talks about authority bias in the military, right? That he would see people with good information deferring to, their commanders who didn't have as good information. And he thought that was very dangerous to his to the SEAL teams, and he identified it as authority bias. And he said, I had to create an insurgent campaign against authority bias. And he made the point that it never goes away. Like, you have to work against this constantly. And I think that's the same situation we're in as investors. These biases that we bring to investing, like not wanting to buy something that's going up, and thinking that the bull market can't keep going. They are pervasive, they are persistent, and they never go away. And you have to work against them as an investor, probably till the day you die.
Yeah. No, you're right. And look at where we're at today. We're seeing a very similar setup that we saw back in the 2015, 2016 timeframe. And, somebody might be biased by losing money during that period of time and say, well, I'm not going to make that mistake again. But now in this situation, you could be dead wrong. And, so I think the thing that what you're talking about is so insanely important for investors to protect against all these different biases that they clearly have and that I clearly have.
Yeah.
And all you can do is continue to reassess and have an appreciation for being wrong is, I think, the best advice that, I can give. And it sounds like you have the exact same opinion, Richard. So,
there was a great book by Ned Davis from Ned Davis Research. And the title of the book is Being Right or Making Money. You want to be right or you want to make money?
Talking about those two different points in time, the 2015 period of time to where we're at right now, I think one of the main things that I'm seeing that's different is back in 15, after the market had what was probably close to a 20% correction, you had every central banker come out and say, we will continue to print. We're going to be more accommodative. I know Draghi over in Europe with the ECB, he came out and said, we will basically not turn off the printing press to continue to allow the economy to grow. But now you've seen that correction whenever the market went down 10% in a very quick amount of time. All the central bankers were kind of like, yeah, well, those things happen. It was it was a much different approach. And now you have Powell, the chairman, he's still saying, hey, next quarter we're raising rates. So that's where I think things are a little bit different now compared to the 2015. And so I wouldn't be surprised to see the market kind of continue to move sideways. If it does go up, I don't think it's going to go up in any type of dramatic kind of way, especially if the central banks continue to raise the federal funds rate and continue to conduct the quantitative tightening here in the United States. I think that quantitative tightening is something that a lot of people might not understand. They might be only focused on the federal funds rate, and the power of them adjusting bonds outside of short-term rates, I think, is a lot more potent and powerful than people might recognize, and what impact that might have on the markets.
And I think it also can contribute to the rising dollar.
Yeah, absolutely. Absolutely. Especially as rates are going up, compared to everyone else who isn't raising rates, they're just kind of holding things flat. It just encourages more people to maybe come into the dollar. And I think that goes against the oil narrative. I know I was talking about why I think you're getting a setup for a similar event to what we saw in the 2007, 2008 timeframe with oil, but I don't necessarily know that you're there yet. I think that you're getting close.
Yeah.
But I don't necessarily know that you're there yet. And I guess I'm talking more of across all commodities. I don't know that you're there yet, but I think you're getting really, really close to being there. And if you see the Fed basically say, yeah, we're not going to raise any rates, and you see them kind of hold them steady, I think that's kind of the trigger for me to maybe go in pretty heavy into some of those positions. But what I want to do is I want to show some more of these countries based on that
ticker
chart.
For small cap U.S. stocks or an ETF.
If you tell me a ticker, I can plug it in.
I was trying to figure it out. It's the index is the S&P 600, but I don't actually know the ticker for it off the top of my head. I was hoping maybe you did.
I don't, but I'll tell you what, why don't you search that? And what I'll do is I'll keep talking with the folks that are watching, and I'll show them a couple more tickers. If you find one, then we can do that.
Okay.
So I'm going to show people India here, and we'll see what this one's doing. Okay, and this one looks pretty similar to the U.S. It didn't actually come down as hard as the U.S. This went into the yellow, so it wasn't recommending a sell through any of this. And now it's starting to come back and rebound. So not really there.
That's something that is great looking. So when you see it come down into the yellow zone there, which the yellow zone, so the VQ on that ETF is 14%, right? Made a high there in, if you can put your mouse over that, that high at $38 in January 2018. And fell, down about 13%, looks like there.
Yeah.
Spurted along, didn't fall more than the normal volatility on that stock, and then rose back out, and the momentum is starting to rise again. So just a little backstory there. When I first created that, what I call the yellow zone there, that yellow line, it was looking for opportunities to buy into things I was interested in at kind of lower risk points, right? So I initially called it the low risk zone because it's a little more than halfway to the stop loss. So just looking at this ETF here, so it was at $38. Well, down at the top of the yellow, it was probably around $34, right? And there was only $4 of not even $4. The red zone is at $32.68. So, there was a couple dollars of risk left as opposed to about, $6 of initial risk. So anyway, what I found though was just falling into that yellow zone wasn't the greatest indicator because things that are falling, sometimes tend to keep falling. So what I found was a better indicator was when it fell into the yellow zone, but then it climbed back out into the green zone. And that's exactly what you see has happened there in that India fund. So that's really interesting.
All right, let's show one more major economy, and this is Japan. This is EWJ.
Okay.
Let's see what we get here. Okay. Oh, this is really interesting. Okay, so this has just turned red in Japan. And what I find interesting is China and Japan are the two that are now in the red. The U.S., India are still in the green. We could pull up some more tickers for other economies. But the reason I wanted to do this is I wanted to show you through statistics that Richard has on his platform. You're starting to show that some of the momentum's breaking down on some economies.
Yeah.
And as we look at this chart, it wouldn't be as obvious to maybe recognize that. I am not suggesting that we are at a turning point. Don't misconstrue that. But I would not be surprised if we were at a turning point.
Yeah, we're definitely seeing some more volatility. Especially in the larger cap, and it looks like certainly in China, and that's kind of surprising about Japan.
So
I did find well, I don't know if you got another one of these that you want to go through, but I got a ticket
here
pull up, which is SLY.
SLY.
Look at this. This is small cap U.S. stocks.
Oh yeah, that is pretty strong.
That's part of what, when I saw the Dow and the S&P really turn red back in January, I did not see the same thing in mid caps. I did not see the same thing in small caps. I did not see the same thing in the NASDAQ 100, right? So it wasn't a breakdown across, the whole markets. It was just really in the large caps. But this small cap U.S. stocks are just roaring. They didn't even, back in that correction in January, I don't think they even fell into the yellow zone.
Yeah, no, they didn't.
And they're just soaring to new highs. So
yeah, that's a really interesting comment there. Here, I'm going to zoom in within the last year. It
yeah,
went yellow for like
it turned
2 days
yellow.
or yeah, 2 days or something like that. Look at this.
Came right back out,
That's
and
incredible.
just roaring to new highs. And I think small cap stocks, they're more domestic focused. They're not as subject to the trade war concerns. And I love small cap stocks for individual investors. I love the idea of individual investors taking advantage of sectors of the markets that the big institutions can't really be as nimble with. So I think drilling down into some small cap stock opportunities is a great thing for investors to consider right now.
So what I did is how we started off with the narrative that maybe where we're at right now is kind of analogous to where we were back in the 2006 2007 timeframe. And so what I did is I pulled up small cap stocks just to kind of see how they performed during that period of time.
Yeah.
And I would have to be able to compare it to the large cap to kind of see the difference. But by the looks of the chart, it performed quite well. Clear up to the point where everything else kind of got pretty ugly. But okay, something else that I wanted to talk about to kind of also show people some of this larger macro theme. There's a organization called the Yardeni Research, and they pump this report out about once a month. Just you can do a Google search and find this. But what I really like about this research report that they put out is they combine the balance sheets of all central banks, and they show basically the expansion of money in the global economy. And what I find fascinating is you can see how much expansion has occurred whenever you combine all these. If you look at this red line, this was the Fed's actions. So the Fed had a huge quantitative easing event. They had more quantitative easing. This is when they went into the Operation Twist, and I mean, it was huge, But say that again, Richard. I didn't hear you.
I said crazy.
It's crazy. And you can see how synchronized all of this is. So when the U.S. kind of did their big move, the ECB was actually tightening through this.
Yeah.
Okay, and then as soon as the Fed was done, it was like, hey, stop and take a breath. So they're there breathing, and the Fed's, in their sprint. And then as soon as the Fed got a bunch of liquidity added into the system, they stopped. They're now breathing, and then the ECB is going, and Japan's going, and it's just quite fascinating to see when you combine all those lines together. This is what you get, which is a pretty darn straight line, kind of showing the monetary expansion.
Oh, interesting.
So when people are wondering why this thing has continued to go for the longest stock market bull market we've seen in U.S. history, I would argue this is why you're seeing it happen. And what I find obviously really fascinating about the chart is you're starting to see a little bit of tightening. Look at all the more that they tightened from a global perspective. And you saw how the markets reacted to that.
Yeah.
it's almost humorous. So thinking about
pretty scary.
It's really scary. And I'm not one to be a fear monger. I think, to be honest with you, there are huge opportunities to make money on the downside, just like there is on the upside.
Sure.
And what I want to do is just make sure people are informed and understand kind of, what's probably driving things more than what others would lead on. And as we watch this, do we really think that they're going to be able to tighten this in any type of significant way without the markets behaving in some type of erratic and volatile way? I would argue no, but I could be wrong. So, and this is another interesting chart where you can see the S&P 500 overlaid with the way that all of that has happened. And you see, I think you see a tight correlation here. Other people might see it differently.
That is a tight correlation.
You could do the numbers on that.
Confirm.
You could do the numbers on
that.
And look at this. I mean, this is just a really cool report. I wanted to throw that out there so people could look at it. And I think that it's a really important thing to understand to combine with a momentum strategy. And I'm obviously a hardcore value investor. So for me to be talking this much macro and this much momentum is way outside of my comfort zone. And I hope that some of my comments are valuable, because this isn't my forte.
Good stuff. I think when you can use more quantitative strategies like momentum, volatility, sometimes they call it factor investing, but you have a sound economic rationale for why you're seeing those patterns. That can be a stronger position to be in as an investor, where you have more conviction about what's going on, right? But I just, I'm so kind of skeptical about my ability to accurately predict what's going to happen in a macro level,
Oh, you and me
or
both.
to be right about when it's going to happen. That I've sort of retreated into more quantitative approaches, overlaid on what I believe to be the kind of core ideas of some of the world's best investors. So some of the guys you talk about, the billionaires, or guys that I've really come to trust and follow. I'm not going to personally be the guy who's doing the deep value dive and reading, the numbers in the quarterly reports, et cetera, right? But if I know somebody has vetted a pool of ideas for value, and then I can lay some quantitative strategies over that, that's my personal comfort zone.
And that's where my approach has adjusted so much through the years, Richard, is I have gained a deep appreciation for how not overlaying different approaches can really be an Achilles heel for a person in their investing strategy. So I'll start off by looking at things that I find is really good fundamental picks. And then I've caught enough falling knives in my life to know that I might want to back that up with an understanding of what does the momentum on this value pick look like before I just dive into this thing.
Right.
And for me, it works so well to filter, look at things from a value investing standpoint. Then once I find something that I really like, what does it look like from a momentum strategy? If it's red, well, I'll just wait a little bit longer.
Yeah.
And until I see some good momentum cues from a statistical standpoint that's saying that, hey, the price action has changed, the fundamentals on it are absolutely awesome. Now I'm going to step into it. So
I'll tell you something interesting that I think you'll find it interesting. But in my own investing, I will give myself 10 to 20% discretion to invest in opportunities that are still red.
I like that. So what drove that strategy?
I think there are limitations to quantitative strategies and momentum strategies, and I think that overall they add tremendous value to my experience as an investor. But I think there are cases, one of them was oil 2 years ago. I had a lot of conviction that oil was bottoming, that I was seeing the momentum turn, and it hadn't turned red yet. It took another 6 months. I hadn't turned green. It took another 6 months for it to turn green. But I saw other things that gave me a lot of conviction that oil was had bottomed.
Yeah.
And so if I have really high conviction about something, and I like, I think it's very important for individual investors to really feel, how do I say this? To engage their conviction in the markets, we're not robots, and I think it's very important that there be an element of discretion and judgment in portfolios. So I think it's great to follow, integrate the kinds of strategies that I offer in trade stops. But I think that it's also great when you can put in a little bit of your own personal judgment about what you really are excited about, what you have deep conviction about, and you can go out on a limb a little bit no matter what any system says. But do that with just a limited part of your portfolio.
Yeah. All right. Well, we'll just wait here for a second to see if we get any questions typed into the chat. If not, we'll just kind of wrap things up. And really enjoyed chatting with you, Richard.
It's always great to chat with you, Preston. I think you guys do a great job on your show. Excited about your success. Congratulations, man.
Oh, thank you. No, I mean, your platform, man. I love it. I use it all the time. I'm being dead serious. This thing is sweet. And it's helped me out a ton with just kind of finalizing where I'm at with things, and really kind of gives me a lot of assurance. The other part that I like is it helps tell me when I'm wrong. You know, if I step into something and it starts going red, I'm kind of like, okay, the math is telling me I'm wrong. So
Yeah,
maybe I can be doing
it's a
this.
good check, you know?
Okay, we got a really serious question right now.
Okay.
LeBron James or Michael Jordan?
You know, basketball never was my specialty, so I think I'll take a pass on that one. You know, not 5'6" when I have you know, some good heels on.
So I'll tell you, I'm deeply biased by my childhood.
Yes.
So I watched Michael
going Michael
Jordan as a
Jordan.
kid. Yeah, I mean, he was my idol as a kid.
Yeah.
I don't really watch basketball anymore. I just kind of read financial statements. So I'm biased, and I would choose Michael Jordan. Oh, hold on. Before we stop, I do want to talk this.
Okay.
Somebody wrote U.S. Energy versus Elon Musk. I would like to talk Elon Musk. I don't even want to say one versus the other. I want to talk Elon Musk, and I want to see, because I have not pulled this up in TradeStop. I am curious what you are showing the momentum on Tesla is. Do you know what it is off the top of your head?
I'm pretty sure it's red.
Oh, yeah? Did it just turn red?
I think it turned red a couple months ago.
I closed the window, so I don't even have it open anymore. But okay, you're saying that you think it turned red.
I can pull it up here. Maybe
Let us know what it is.
Yeah, it is red. So it's red. And it turned red at around
right when he tweeted
$173 back in March of 2018. So it's been red for quite a while.
Oh, really?
And the momentum, the trend indicator is flat to down. And interestingly, the volatility quotient on Tesla is 31%.
Oh, yeah, of course.
So it's a very volatile stock.
Yeah.
You know, that's down from, it used to be like 2 years ago, it was in the 40s, you know, in the low 40s, 43, 44%. So, so it's gotten more volatile in the past 6 months. But yeah, it turned red about 5 months ago. And in spite of Musk's tweet, it's has not passed the test to turn green again.
Yeah. No, I mean, I have major concerns. I have major concerns with him as just kind of the executive at this point. I think that there's some really weird stuff happening. I don't think that it's normal to see a guy posting a picture saying I'm bankrupt next to one of his cars. I don't think that it's normal to see a guy, you know, acting like that in an analyst call, let alone a tweet saying that funding's secure when funding isn't secured. I think that I am basing this on very little data, but for me, it makes kind of the hairs on my back stand up, like something just isn't right. And, you know, at the end of the day, there are a ton of other businesses you can invest in all over the world. And so why do I have to be polarized into something that has...
That's the main point. You know, I was going to say, well, I agree with you and I have the same feelings, but we don't live in normal times.
That's for sure.
I have that feeling about a lot of different situations, you know, that it's hard to believe, you know, that they're still in business or in politics.
Yeah.
But, you know, we don't live in normal times, but I agree with you 1,000%. And I hate to say that as somebody who's statistically knowledgeable, you know, because really it's 100%, right? There's no such thing. But anyway, that there's so many fish in the sea, you know, and focusing on Tesla is a fool's game.
I think so.
When, you know, it's a media darling. That is, you know, that's herd investing.
Especially when it's capitalized at a higher multiple than, or at a higher market cap than businesses that are 100 times bigger and 100 times more profitable.
Yeah.
I
Go
mean,
find
it's
a
like,
small cap stock that's working on batteries that Tesla will use in its cars or something.
yeah, yeah,
It's just, yeah, stay away. Don't play
yeah,
that game.
yeah. I'm with you, but who knows? Yeah, it's definitely not a pick for me. But anyway, all right, Richard. So people listening to this, I'm sure you guys saw the platform we were using. Richard comes from Trade Stops. Richard, anything else you want to add? Tradestops.com is the domain of his website. Anything else you want to add? Are you on Twitter or something like that for followers?
Um, I don't do a great job on social media yet, Preston. I need some lessons from you, I think.
That's why you're so successful.
I'm getting there. No, I guess I would just say that, again, I think that the U.S. markets are strong. I think small caps and mid caps are a great place for investors to explore a little bit. And it's great being on, spending some time with you.
Yeah, no, it was awesome chatting. We definitely need to do this again sometime and just kind of show people where we're at from a momentum standpoint. I'd love to do this again, like quarterly or something.
Well, read that book, Team of Teams, and then let's talk about that
Yeah,
on Hangout
I want to check
sometime
that
and
out.
how it applies to investing.
I want to see his book. I want to see what he's up to now.
Yeah.
All right. Well,
Awesome.
great chatting with you.
Thank you, Preston. Have a great night.
Yeah, you too. We'll see you. All right, guys. Thanks for watching. I'm going to go ahead and hang up. Have a good night. Sleep tight.